When building your financial future through retirement accounts or employer-sponsored plans, the terms pre-tax and after-tax contributions frequently arise. These two contribution types play a pivotal role in how your money grows, how much you pay in taxes today, and how much you owe when you withdraw funds in the future. Pre-tax contributions lower your taxable income today and defer taxes until retirement, while after-tax contributions are made with money that's already been taxed, with potential for tax-free withdrawals depending on the account type. Understanding these distinctions is crucial for optimizing retirement savings, minimizing tax burdens, and aligning financial choices with long-term goals. In this video, we explore the top 10 key differences between pre-tax and after-tax contributions to help you make informed decisions about where to put your money. 1. Immediate tax impact on income. The most obvious difference between pre-tax and after-tax contributions is the effect on your current taxable income. Pre-tax contributions are deducted from your paycheck before income taxes are applied, reducing your taxable income for the year and potentially lowering your tax bracket. For example, if you earn $80,000 annually and contribute $10,000 to a traditional 401k, only $70,000 is taxed. In contrast, after-tax contributions do not reduce your taxable income. They are made from income that has already been taxed, offering no immediate tax relief. 2. Taxation at withdrawal. How your contributions and their earnings are taxed upon withdrawal is another critical difference. With pre-tax contributions, such as those to a traditional 401k or IRA, taxes are deferred until you withdraw the funds in retirement, at which point withdrawals are taxed as ordinary income. In contrast, after-tax contributions, especially to Roth accounts, are withdrawn tax-free, provided certain conditions are met, e.g., holding the account for 5 years and reaching age 59 and a half. This distinction allows investors to strategically plan their retirement withdrawals based on projected future tax rates. 3. Eligibility and income limits. Pre-tax contributions to accounts like 401ks are available to all eligible employees regardless of income. However, some pre-tax accounts, such as traditional IRAs, have income limits for deductibility if you or your spouse is covered by a workplace retirement plan. Conversely, after-tax contributions, particularly to Roth IRAs, are subject to income phase-outs. For example, in 2025, single filers earning more than $161,000 cannot contribute to a Roth IRA directly. These eligibility rules play a crucial role in retirement planning and determining which account types you can use. 4. Contribution limits and allocations. The IRS sets contribution limits for retirement plans, and the treatment of pre-tax versus after-tax contributions affects how those limits apply. For 401k plans in 2025, the total employee elective deferral limit is $23,000, which can be split between pre-tax and Roth, after-tax, contributions. After this, some employers offer after-tax non-Roth contributions up to a total plan contribution limit, including employer match, of $69,000. Understanding these caps helps maximize savings, especially for high earners using strategies like the Mega Backdoor Roth. 5. Employer matching contributions. Employer matching contributions are always made on a pre-tax basis, regardless of whether you choose pre-tax or after-tax employee contributions. This means that even if you contribute to a Roth 401k, the employer's matching funds will go into a traditional pre-tax account. These matched funds will be taxed when withdrawn, so even Roth users must manage both taxable and non-taxable retirement income sources. This dual treatment makes it important to track and understand how different contributions are handled within your plan. 6. Growth and tax treatment of investment earnings. Both pre-tax and Roth after-tax contributions allow your investments to grow tax-deferred while in the account. However, the eventual tax treatment of those earnings differs. For pre-tax contributions, all withdrawals, including investment earnings, are taxed as ordinary income. For Roth after-tax contributions, both the original contribution and the earnings can be withdrawn tax-free if qualified. This makes Roth contributions especially appealing to younger investors who expect decades of compounding growth and potentially higher tax rates in retirement. 7. Withdrawal flexibility and penalties. Pre-tax and after-tax contributions also differ in their withdrawal rules and penalties. Pre-tax contributions and earnings are generally subject to a 10% penalty if withdrawn before age 59.5 unless an exception applies. Roth contributions, on the other hand, can be withdrawn at any time without taxes or penalties. Only the earnings are subject to tax and potential penalties if withdrawn early. This makes Roth accounts more flexible in emergencies or for early retirement planning, while pre-tax accounts are better suited for traditional retirement timelines. 8. Required minimum distributions, RMDs. Pre-tax retirement accounts, such as traditional IRAs and 401ks, are subject to required minimum distributions, RMDs, starting at age 73, as of 2025. These mandatory withdrawals are taxed as ordinary income, which can impact your retirement budget and tax bracket. Roth IRAs are not subject to RMDs during the original owner's lifetime, making them advantageous for tax-free growth and estate planning. Roth 401ks used to have RMDs but no longer do, starting in 2024. This gives after-tax Roth accounts a significant edge in long-term tax planning. 9. Strategic use based on future tax expectations. Choosing between pre-tax and after-tax contributions depends largely on whether you expect your tax rate to be higher or lower in retirement. If you believe you'll be in a lower tax bracket after retirement, pre-tax contributions make sense. They reduce taxable income today and defer taxes until a time when your rate is lower. If, however, you expect higher taxes in the future or want tax-free retirement income, Roth, after-tax contributions are more favorable. This strategic forecasting is a core principle in tax-efficient retirement planning. 10. Role in tax diversification. Tax diversification refers to the practice of holding different types of accounts, pre-tax, after-tax, Roth, and taxable, to provide flexibility in managing income and taxes in retirement. By having a mix of account types, retirees can choose which accounts to draw from in any given year to minimize taxes. For example, withdrawing from a Roth account can help avoid pushing taxable income over a Medicare premium threshold or into a higher tax bracket. Including both pre-tax and after-tax contributions in your portfolio enhances your ability to adapt to future financial situations. Understanding the key differences between pre-tax and after-tax contributions is vital for effective financial and retirement planning. While pre-tax contributions offer immediate tax savings and are suited for those seeking to reduce taxable income now, after-tax Roth contributions offer long-term advantages such as tax-free growth, greater withdrawal flexibility, and estate planning benefits. By evaluating your current income, future tax expectations, employer plan options, and financial goals, you can create a balanced, tax-efficient investment strategy. In most cases, a combination of both types of contributions, creating tax diversification, can provide the best of both worlds and prepare you for a variety of future scenarios.